All right, as part of my series on the battle of vacation rental platforms, today we're going to talk about Here. I originally got exposed to Here about a year ago and really thought like their model was interesting. They were brand new, they just launched like a couple properties on the platform. Those properties sold out really fast, which, was great. And what Here does at its core, if you're not familiar with them, is they make it easy to invest as little as $250 into vacation rental properties. And then what they do is they do it as a crowdfunding mechanism where they get lots of investors that all put in, hundreds, thousands of dollars. They aggregate that. They use the money to then go and purchase the property. And then they manage it on your behalf, rent it out, and pass along the profits or the dividends from that vacation rental. And so if you really wanted to get into the Airbnb game, but you didn't have, the $100,000 that was necessary as a down payment, you could invest in through Here, platforms like Here, for as little as like $250 into those same types of properties and generate somewhat similar returns. Now, I should preface this video with saying this is not investment advice. This is for entertainment and educational purposes only. But I wanted to go through it because I love Airbnbs. I've been an investor in Airbnb before they went public. I own several Airbnbs that I rent out. And I've been using Airbnbs almost from the very, very early days when they launched. So huge fan of Airbnb. I love this concept of making it possible for the average person to be able to invest in Airbnb and short-term vacation rentals. I think it's great. And I thought it'd be helpful to actually sit down as somebody that's been doing real estate investing since I was a teenager and has these types of properties to actually dive in and see how I would think about this as a potential investor, investing in Airbnbs or other vacation rentals through Here. So let's dive in to one of their properties. So their current property that they have listed that's available to invest in is this one in Panama City, which I think is kind of funny because their main competitor, Arrived, has a property in Panama City as well that they are raising money for. And so it's kind of fun because you can look at both and you can compare both in real time and try to decide which one is the better investment. And if you haven't, go and watch my video where I evaluate Arrived's Panama City property. All right, so let's dive into this one. So right off the bat, I'll tell you, compared between Arrived and Here, I think Arrive does a better job in terms of giving you access to a lot more information about the property. This is good information, but there's a lot that I feel that is missing here. So one, we understand what the property looks like. It's 5-bedroom, 4-bath, so it's a little bit bigger than the other property on Arrived. Sleeps 12, almost 2,600 square feet. If we look at the pictures, it's also got a pool. It looks like it's a new build, which is interesting. It's going to have some pros and cons relative to the other one, where, it's not going to require as much upfront maintenance, for example, and will be a little bit more trendy in terms of the internal furnishings and so forth. But I think the Arrived one, they're going to, they've set aside some money to increase or to, remodel the property and make it nice too. You got your furniture and everything. So, look, it looks nice, right? Looks like the kind of place that people would like to buy. Offering amount is $1.4 million. Not exactly sure how that breaks down, so we'll have to go searching for that. Popular destination, blah, blah, blah. Okay. Expected payout date. So start paying back investors their portion of dividends or the rent in November. So that's like 6 months. That's quite a while to wait. 0% financing. So they're not going to borrow any money on this. You're not getting any benefit from leverage. Whereas this is important because, let's say I went to go buy a property. There's a good chance that I'm going to borrow money to buy that property. And so if I buy $1 million property and I put down 20%, yeah, it's 200 grand, which is a lot of money, but it's only 200 grand out of a million, right? And so then when I sell it, let's say I sell the property a few years from now for $1.2 million, so it goes up by 20%, then I'm going to pay off the loan. Let's say I don't even pay off much of the loan during that hold period, so I still owe 800,000. I'm going to pay off the 800,000. I'm going to be left with 400 grand in my pocket. I will have doubled my money. On the other hand, if I put up the full $1 million to buy that property and then I sell it for 1.2 million, I haven't doubled my money. It's only gone up by 20%. So leverage can be like this huge benefit, and the fact that they're not using it like already puts you as an investor at a disadvantage. Now, the upside of that, the advantage you have is that you're probably not going to lose much money on it either, because leverage can also work against you. So let's say that, I end up selling, property values decline because I bought this thing at the all-time peak, and now property values are like at 100,000 or 700,000. Well, in that case, I will have lost my entire 200,000, and I'll have to come out of pocket another $100,000 to make up the difference, right? Whereas if I had just bought the property for $1 million, I won't have to come out of any more cash out of pocket to cover that loss. I would just take the hit and not get my full $1 million back. So leverage can work against you and can be risky, but generally houses are relatively safe investments. It's not likely that your house is going to go down in value by more than 20%. On average, right? Now, there are certain circumstances where, of course, that happens and there is risk, but, that's why banks are willing to lend 30-year mortgages on houses, is because typically they go up and to the right over the long run. They're relatively low risk assets. So if we look at this, they're saying that they think average revenue per month will be about 14,490. So if we, let's see, 14,500 times 12, so that's $174,000 in estimated rental income per year. So that's a little bit higher than the Arrived one if you go watch that. If you look at home values, now this is interesting and somewhat concerning in my opinion. And that is like, if you look, like this property just 2 years ago was worth $284,000 in this market. Like, that's what Zillow would estimate it at. And today is worth, almost double that, but now it's coming down. So it feels like you might be buying this a little bit at a peak. And we don't know how much more real estate prices are going to come down. It could be that like this is kind of the dip right now, and now is the time to buy, and then it's going to start going back up again. But we could be in for more of a shock. So it's hard to know. I mean, you can see these like similar dips in prior years. 2021 was like this exception, and the reason why 2021 saw such a huge increase in property values, and to a certain extent 2022, but really 2021 didn't have this dip that you see in prior years. The reason for that is because there was so much money pumped into the market in 2020 that all of that money had to go somewhere, and a lot of it went to real estate, pushing up real estate prices across the board, as well as prices of all assets and lots of things that we buy, consumables, and that's why inflation is up quite a bit. So let's see what other fees to expect. So let's see, they have onboarding, creating all the stuff. Okay. One of the things that I think is interesting that's different about Here and Arrived is that Here is their own property manager. They manage the properties themselves, which I think is interesting. They're not outsourcing that, which probably has pros and cons. Ultimately, I think it's probably a pro. I would like to have like really good alignment with Here and myself as a property owner, and knowing that like they're involved, they're checking on it every day, monitoring it very closely on my behalf. Flip side of that is that Here can't be everywhere, right? They can't have teams everywhere. They're going to lose out on economies of scale, and so A local property manager, probably all things being considered, can manage the property more efficiently than here can, but then you're also paying them out and they've got to generate profits. And so I don't know, it's probably a wash in my opinion. Once an investor has placed an investment, blah, blah, blah. Let's see. Okay, so how do they make money? So this is important because in exchange for the ability to only have to put up $250 to get access to this asset class and to be able to have like a diversified portfolio, that's going to cost you something, right? Like there's no free lunch. And so it's important, I think, to understand how much they charge. So they collect a quarterly asset management fee of 20.25%. So that means that they're charging 1% of total assets of each property on the platform. So what I don't know is if that's that $1.4 million. But if it is, then that's 1% of that every year. So, $14,000 is charged. And then they also collect a management fee of 25% based on gross revenue that they, let's see, and this is paid out each month. I think 25% is a little bit high, but not aggressively so. If I wanted to hire a property manager to manage my properties, it would cost me 20 to 25%. Some places it's higher, but 20, 25% is totally reasonable range. So look, in this case, they're going to be generating $43,500 annually of the rental income plus another $14,000. So like $57,000 from this property, and the property is generating 106. So there's going to be about 118,000 available for to be dividended out theoretically. Although there's probably also like a bunch of taxes and fees and maintenance and other things, and so maybe it's like really closer to 100,000. So if you figure that it's about 100,000, you're dividing that by that 1.4 million. So you're looking at a dividend rate of about 7%. That's pretty high. That's pretty good, actually, I feel like. Now, that's, who knows if they'll be able to rent out enough to generate that kind of gross revenue. And we don't know what the exact expenses are for the other things. But a similar property, a little bit smaller, a little bit cheaper on the Arrived platform, they're forecasting about a 4.5%. And I think the reason for that is because they charge a lot more the gross rental income. So they're charging 15% for the property manager. That just goes to the property manager. But then they're charging a full 25% on top of that of their fees to manage it, AUM fees, et cetera, et cetera. So they're charging a lot of money on that property. And that is really driving down the amount of money that's available for investors. So that's why they're forecasting 4.5, and I'm estimating something around the 7% range for this one. Now, highly recommend that you check out the offering circular here. It's important to note that in this offering circular, they have two interests, series interests. What that really is saying is they're going to have this master LLC agreement, and then they'll have series within that LLC agreement for each property. And this property in particular is Series 18. You can see that because it's the 1.4 million that they're raising to buy the property. And what I would do is I would sit down and I would want to see what's the use of proceeds. So here we are, Series 18. So they've got 14,000 going out to brokerage fees. They have the purchase price of the property. Ironically, the purchase price of this property is $816, which is the same price as the property that on the Arrived platform, despite the fact that this is a newer property and a larger property. So right off the bat, I feel like here is getting a better deal. Then they're anticipating $250,000 for anticipated furnishings and repair costs. That feels really high. I wouldn't anticipate, since it looks like it's a new build, I wouldn't anticipate there being very many repair costs. So 250K in furnishings feels extremely high. That would be a little bit of a red flag to me. Then they have their offering expenses. This is the amount of money that they get paid for basically putting the property out there and letting people invest in it. So, you're going to be paying roughly 2.8% of your investment out to them right at the very beginning. And then they've got their operating reserve, which is just money that they put aside for any ongoing fees, so that they have some buffer there. And then they have their service fee, which is $210,000. And this fee payable to here in connection with research and negotiation of the property purchase and coordination of the work needed to prepare the property for rental. So this is another fee that they're getting. And look, I think this is an interesting fee to point out because they're paying more out in dividends, but that's the risky side of what they're doing. So think about it this way. I'm going to charge almost 15%. So okay. So think about it this way. You're going to invest $100 into one of their properties. Now, I know the minimum's $250, but just hang with me for the math. $15 of that right off the bat is going out to pay here. And then they're probably also making money on the brokerage commissions. And if they're not, they will be soon, I bet. And then they also have like managing member for offering expenses actually incurred offering. So even though they have expenses, they're charging you for them. So that's still money that's coming out of your pocket. So that's another 2.8, another 1. So, I mean, you're looking at roughly almost 20% of your investment. So you invest $100, call it $19 of that is going out the door to pay fees to here. Which means that you're only really investing $81 into the actual property. And then you've got like all of these different fees and so forth. And then after that, that's like the not risky part for here, right? Like they raise all the money, boom, we're going to take 200 grand off the top. We're going to put it in our pockets. And then the risky part of this is we don't know if it's going to rent super well. So we'll give you more of the rental income on the backside. Arrived kind of does it the opposite way. They do take a chunk of money in a service fee, but it's a lower amount. It's like 40. I think when I went through and calculated everything, it's about 70 grand. So it's a lower amount, but then they give you less of the dividends on the back end. My guess is that it's probably all a little bit of a wash. I mean, let's say you hold this property for like 5 years, then, you're paying out $40,000 a year of your gross rental income plus the, and 40 divided by 176, that's 22%, 23%, plus you're going to pay another 25. So that's like almost 50% of the revenue that comes out of the property on an annual basis is getting paid out to here, which is actually really close at the end of the day to what Arrive does. So it's interesting how here like front loads a lot of those expenses, which actually really hurts your IRR, and Arrive kind of backloads that and takes some of the risk alongside you on the rental income. Anyways, yeah, I think it's interesting. They also here doesn't talk a lot about appreciation, which makes sense because if you're going to make money on the appreciation, then you have to believe that this property that you bought for $816,000 is eventually going to be worth more than $1.4 million. Otherwise, you actually end up losing money on this deal. And, that's almost like a doubling. That feels like a little bit of a challenge to me because over the long run, real estate doesn't increase that much year over year from an appreciation perspective, especially if you exclude the last 24 months or so where we've seen like massive gains in property values. So yeah, I don't know. That feels aggressive. I think here's fees are like really high here and something that really makes it challenging to make much money off the appreciation. Whereas I think Arrived, they're taking a little bit more of the rental income on the back end, but you actually have a better chance of generating income on the appreciation of the asset over time, which I think is interesting. I don't know. In both cases, like, it's hard for me to get excited about these platforms because I'd rather just figure out a way to invest in the property directly and not pay out such high percentages. But if you really want to be in this space and getting into an Airbnb direct is, too challenging given your financial circumstances, and or you feel like you are a more risk averse individual or just don't have the time to manage these types of things and do the research and figure it all out and furnish and like all of that stuff, and you just want to be in the space, then I think these can be like really great ways to include vacation rentals into your overall portfolio. Anyways, I hope this video was helpful to you. Be sure to check out my other videos in this series on the battle of vacation property rentals. Thanks.